This April, something is going to happen to the state pension that has never happened in its entire history. And it's going to split every pensioner in the country into two groups. One group is going to be completely fine. They won't pay a penny more in tax, they won't have to lift a finger, they can carry on exactly as they are. The other group is going to get a nasty surprise, a tax bill, possibly for the first time in their lives, on income that used to be theirs to keep. And here's the unsettling part. The difference between those two groups isn't how rich you are. It isn't how big your savings are. It comes down to one specific thing about your income, and most pensioners have absolutely no idea which side of the line they're standing on. You could be in the safe group and be worrying for nothing, or you could be in the group that's about to be taxed and have no clue it's coming. By the end of this video, you will know, with total certainty, exactly which camp you're in. Now, you may have seen scary headlines screaming that pensioners are going to be taxed. Let me be crystal clear right now, because the truth matters, and a lot of what's being said out there is flat out wrong. It is not true that every pensioner will be taxed. The government has made a very specific promise that protects a whole group of people entirely. But that promise is narrower than the headlines make it sound. And if you misunderstand it, you could get caught out badly. So today I'm going to show you exactly what's changing and why. And then I'm going to sort you personally into one of two camps, the safe camp or the taxed camp, with a simple check you can do in your own head. And I'll show you what to do if you land on the wrong side. But stay with me, because you have to understand how the trap works before you can tell which side of it you're on. My name's Robert, let's get into it. So let's start with what's actually happening, because this hasn't come out of nowhere. It's the result of two things quietly heading towards each other for years, like two cars on the same road, and this April they finally crash. The first is your state pension going up. Every April, under a rule called the triple lock, the state pension rises by whichever is highest of three things: inflation, average wage growth, or 2.5%. It's a guarantee that your pension keeps climbing, and it has done exactly that year after year. This past April it went up by nearly 5%, and the figures coming out right now suggest another solid rise is on the way for April 2027, so the amount you receive keeps getting bigger. Good news on the face of it. The second thing is the tax-free personal allowance, the amount of income you're allowed to receive each year before you pay any income tax at all. Now, normally that allowance would rise a bit each year to keep pace with the cost of living. But it hasn't. It's been frozen, completely stuck, at £12,570 since 2021. And in the last budget, the government confirmed it's staying frozen all the way out to 2031. So while your pension climbs, the tax-free line stays nailed to the floor, not moving an inch. Now here's the collision. For years, the full state pension was comfortably below that tax-free line, with plenty of room to spare. But every April, as the pension rose and the line stayed frozen, that gap got smaller and smaller. This tax year, we're in 2026/27. The full new state pension pays out £12,547, sitting just £22 below the frozen allowance of £12,570. £22. That's all the room that's left. So next April, in 2027, when the pension rises again by even the smallest amount, it will finally cross that line. And the full state pension will, for the very first time in history, be larger than the tax-free allowance. That is the moment everything changes. Let me explain what that actually means for you. So, the full state pension is about to poke its head above the tax-free line. What does that actually do? This is where people either panic unnecessarily or fail to see a real problem coming. So let me walk you through it slowly and carefully. Here's the key thing to understand, and it surprises a lot of people. Your state pension is taxable income. I know it doesn't feel like it, and that's odd. It feels like something separate, a benefit you're owed. But in the eyes of the taxman, every pound of your state pension counts as income, and it uses up your tax-free allowance just like a wage would. So picture your allowance as a jug that holds £12,570. Your state pension gets poured in first, and up to now it only filled the jug part way, leaving room at the top for other income, a small private pension, some savings interest, to be poured in tax-free as well. But from April 2027, the full state pension doesn't just fill part of the jug, it fills it right to the brim, and then a little spills over the top. Now that little bit that spills over, the amount by which your pension exceeds the allowance, is technically taxable. Early estimates suggest the pension could end up a few £100 over the line. So on paper, for the first time, someone whose only income in the whole world is the full state pension has technically become a taxpayer on that small overspill. Now, the tax on just that little overspill would be tiny, a few pounds a year, and chasing millions of pensioners for a few pounds each would be absurd. Everyone can see that, which is exactly why the government stepped in with a promise. And understanding that promise, who it protects and who it doesn't, is the whole key to knowing which camp you're in. Let me explain it precisely. But first, one quick thing. For those of you who'd rather have all of this, the state pension, this tax trap, pension credit, council tax help, the allowances and the deadlines that catch people out, written down in plain English in one place, I've put it into a guide called the UK Pensioner Survival Playbook for 2026 and 2027. No jargon, nothing complicated. If you'd like it by your side, the link is in the description below at robertretires.com/UK. That's it. Now, let me sort you into your camp. Here's exactly who pays and who doesn't, and how to tell which one is you. Right, there are two camps, and I'm going to describe each one clearly so you can place yourself. Let's start with the good news. Camp 1, the safe camp. Camp 1 is for pensioners whose only income is the state pension, nothing else at all. If the state pension is the single, solitary source of money coming into your household, no private pension, no workplace pension, no earnings from work, no meaningful savings interest, nothing on the side, then you are in the safe camp, and here is the government's promise to you in plain terms. The Chancellor has confirmed that pensioners whose only income is the full new or basic state pension will not be made to pay income tax on that small overspill, and will not be dragged into the tax system to do it. They won't be put through something called simple assessment. They won't get a tax bill. They won't have to fill in a form. The government has said it will simply leave that tiny amount alone, and it's committed to that for the rest of this Parliament. So if that's you, the state pension, and truly nothing else, you can breathe easy. You do not need to do anything. You will not be taxed. The scary headlines are not about you. But, and this is the single most important word in this whole video, that promise comes with a condition so specific that it excludes far more people than you'd think. And this is where Camp 2 comes in, and where people are going to get caught. So let me describe Camp 2 very carefully, because there's a good chance it includes you, even if you don't expect it to. Camp 2 is everyone else. And everyone else is a much bigger group than the headlines admit. Here's the rule that defines it. The moment you have any income at all on top of your full state pension, you fall out of the safe camp and into the camp that pays tax. Even a small amount, even a little. Let me give you real, everyday examples, because this is where it becomes clear just how many ordinary people are caught. Imagine you're on the full state pension, and you also have a modest works pension. Say a couple of £1,000s a year from a job you had decades ago. You are in Camp 2. Or you're on the full state pension, and you've got a bit of money in a savings account earning interest above your savings allowance. Camp 2. Or you do a few hours of paid work here and there to keep busy and top up your income. Camp 2. Or you deferred your state pension in the past and now get a slightly higher amount because of it. Those extra amounts, called increments, can push you out of the protected group too. Now here's why being in Camp 2 matters so much more than that tiny overspill on the pension itself. And this is the part the headlines completely miss. It is not really about the few pounds of tax on the pension crossing the line. It's about what happens to your other income. Because once your full state pension has filled your entire tax-free allowance to the brim, there is no room left in the jug for anything else. So every single pound of that other income, the first pound of your works pension, the first pound of your savings interest, the first pound you earn from work, is now taxable at 20% right from the start. Income that, in the past, would have tucked neatly into the space under your allowance, tax-free. Let me put a number on it so it really lands. Say you're on the full state pension and you have a small private pension of £2,000 a year. In the past, a chunk of that £2,000 could sit in your leftover allowance, tax-free. From April 2027, with your allowance completely swallowed by the state pension, that entire £2,000 becomes taxable. That's £400 a year, gone to the taxman, on income that used to be tax-free or nearly so. That is the real sting, not a few pounds, potentially hundreds, and it lands on millions of ordinary pensioners with even the smallest second income, none of whom are protected by that government promise. So let's make this dead simple. Here is the check you can do right now, in your own head, to know which camp you're in. Ask yourself one question. Apart from my state pension, do I have any other income at all? Any private or workplace pension, however small, any earnings from any kind of work, any savings interest above my personal savings allowance, any other income of any kind? If the answer is a clear, honest no, the state pension is genuinely all I have, then you are in camp one. You are protected. Relax. Now, in reality, that's a smaller group than people assume, because most pensioners do have at least a little something extra. But if that's truly you, you're safe. If the answer is yes, I do have a bit of something else, then you are in camp two. And you should assume your other income will be taxable from the first pound once this lands. That doesn't mean you've done anything wrong, and it doesn't mean disaster, but it does mean you need to pay attention, check your tax code, and take the steps I'm about to give you to protect what you can. Most people watching this, if they're honest, are in camp two. So let me show you what to do about it. So you've placed yourself in camp two, you've got the state pension plus a little something else. Here's how to protect your income, and there are real legal moves you can make. The first and the biggest for most people is the ISA. Here's why it's so powerful right now. Any interest you earn inside a cash ISA is completely tax-free. And what? This is the key part. It doesn't count as income in the eyes of the taxman at all. So it never goes into that jug, never fills your allowance, never gets taxed. Think about what that means. Your savings interest is exactly the kind of income that's about to become taxable because your allowance is full. But move that money into an ISA, and the interest becomes invisible to HMRC completely. So if you've got savings in ordinary accounts, shifting them into an ISA over time protects that income entirely. And for anyone over 65 especially, this matters more than ever. The second is the marriage allowance, and couples leave a genuine fortune on the table by not claiming it. If you're married or in a civil partnership and one of you has income below the personal allowance while the other is a basic rate taxpayer, you can transfer a slice of the unused allowance from one partner to the other. It's worth over £1,000 and you can often backdate it several years. If that describes you, it's free money sitting there unclaimed. Go and get it. The third is to stay alert to your tax code and any letters from HMRC. As more pensioners are pulled into paying tax, more of you will start receiving something called a simple assessment, a letter telling you what you owe. Don't just assume it's correct. Mistakes happen and it's your money. And crucially, if your income is genuinely low, please check whether you qualify for pension credit. It can be worth thousands of pounds a year. It opens the door to all sorts of other help, and hundreds of thousands of pensioners who are entitled to it never claim it. Knowing where you stand, sheltering your savings, and claiming what you're owed, that's how you keep the taxman's hand out of your pocket. Now, before I let you go, a few honest points because precision really matters on this one, and I don't want you misled. First, the exact figures aren't fully locked yet. The precise size of the April 2027 pension rise depends on economic figures that are confirmed in the autumn, the September inflation number and the wage growth data. So the pension might cross the line by a little or by a bit more, but cross it almost certainly will. The direction is set, even if the last decimal point isn't. Second, and this is important, this problem doesn't stop in 2027, it gets worse every year after. Because the allowance stays frozen until 2031 while the pension keeps rising, the gap keeps widening, and the amount of your income exposed to tax grows every single April. 2027 is just the year the door opens. And there's always a chance the government changes the rules. There's pressure on them to raise the allowance for pensioners, so watch this space, but don't count on it. And third, for my viewers in Scotland, your income tax bands work differently. So the exact rates and thresholds won't all apply to you in the same way, though the underlying squeeze from the frozen UK-wide allowance is the same. And whatever your situation, if your affairs are at all complicated, this is exactly the kind of thing where a little good guidance pays for itself. There's free, government-backed help available, and charities like Age UK, who will help you understand your position and make sure you're claiming everything you're entitled to. The bottom line is this. This April, the state pension crosses the tax line for the first time in history. If the state pension is truly all you have, you're protected. Relax. If you have any other income, assume it's now taxable from the first pound and take the steps to shelter what you can. Know your camp and you're in control. So let's bring it home. This April, the full state pension will, for the first time ever, rise above the frozen tax-free allowance, and it splits pensioners into two camps. Camp 1, the state pension and nothing else. You're protected by the government's promise, and you don't pay. Camp 2, the state pension plus any other income at all, and that other income is now taxable from the very first pound. Do the check. Is the state pension genuinely all you have? That one question tells you your camp. And if you're in Camp 2, shelter your savings in an ISA, claim the marriage allowance if it fits, keep an eye on your tax code, and check pension credit. If this cleared things up for you, do me a favour and share it with another pensioner. There is so much confusion and fear about this, and the truth, laid out properly, is a real relief for some and a vital warning for others. Hit subscribe for more, and if you'd like it all written down in one place, the Pensioner Survival Playbook link is in the description. I'm Robert. Look after yourselves, look after your money, and I'll see you in the next one.